Welcome, dear traders. You are watching a recap of the Asian session on September 5. On a Tuesday, Asian stock indexes posted declines, with the China stock showing the worst performance. Stock indexes in Australia, Japan and New Zealand were also in the red. Today's inflation and economic data in Asia were among the main reasons for cautious trading in the market. The currency markets were more stable as the trading volumes were lower due to the holiday in the United States. However, assets still price in expectations that the Fed may keep its interest rates high this year. Some investors factor in another quarter-point hike at the Fed meeting in November or December. On the other hand, ongoing deflation and rising unemployment lower expectations of a further monetary policy tightening in the United States. Currently, the FEDWATCH tool shows more than a 90% probability that the regulator will keep interest rates unchanged on September 20. About 60% of the market believes that the Fed will stick to the current rate in November. Meanwhile, the People's Bank of China is cutting interest rates. China is taking measures to strengthen the yuan and its economy. For example, Beijing is expected to ease restrictions on home purchases. Meanwhile, worries about problems at the nation's largest private real estate developer have not abated. On a Tuesday, Reuters reported that Country Garden Holdings was late with the interest payments on $2 bond coupons due last month. The grace period for coupon payments ended on a Tuesday, so the company managed to avert default. Meanwhile, investors are still concerned about slowing economic growth in China. China's stimulus measures in recent months are setting the stage for sentiment in the Asian-Pacific region and putting pressure on the US dollar. On the other hand, the prospect of another Fed rate hike continues to support the rise in the US Treasury yields. In addition, these expectations boost the US currency. Despite some declines, technical indicators point to a short-term bullish trend after the US dollar rebounded from the support level of 102.50 last week. At the beginning of Tuesday, the US dollar index is still hovering at the level to which it climbed after the release of non-farm payrolls on September 1. Its price against its G6 counterparts was moving within the ascending trading channel of 104.10 and 104.50. The US dollar closed the Asian session inching higher to 104.40. With the US Non-Farm Payrolls showing both job growth and rising unemployment with a slight decline in wages, the US economic recovery no longer looks so robust. As a result, the US dollar rally is losing momentum, so its counterparts may have a chance to strengthen. For example, on September 1, the greenback tested 144.70 against the yen before rebounding. On a Monday and early Tuesday, the US currency continued to rise moderately within the range of 146.40 and 147.10. As a rule, the US dollar strengthens in Asian trading. Today, the dollar-yen pair climbed to almost 147. Meanwhile, technical indicators suggest that the pair may soar to 150, and this is likely to occur if there is no sharp change in the gap between the bond yields of the United States and Japan's central banks. Notably, the Japanese government bonds are pegged to zero, and the yield of Treasury bonds exceeds 4%. The auction of Japanese government bonds may change the situation on Tuesday. However, the authorities are likely to keep a close eye on the level of 150. As we have already seen, the Bank of Japan can intervene in the market. As for the state of the Japanese economy, the overall business activity in the country has grown. The PMI composite rose to 52.6 points in August 2023, and this was the 8th consecutive month of growth in the private sector and the 3rd consecutive month of growth in the service sector. At the same time, Japanese industry, on the contrary, is sagging. Notably, manufacturers reported a decline in the new orders for the 3rd month. The yen's weakness pushed inflation in Japan to its highest level since May, amid stronger growth in both manufacturing and service sectors. Today, markets assessed Australia's PMI composite data. The report showed that business activity in the country slipped to 48 points. In August, the index posted the lowest level since December last year. In addition to weak economic data, the Australian dollar was under pressure from the country's central bank early Tuesday. At today's meeting, the Reserve Bank of Australia decided to leave the rate unchanged for the 2nd time in a row. At the same time, the regulator notes that inflation has already peaked. However, the indicators keep showing high levels and will probably hold at these levels for some time. Notably, the last meeting was held under the leadership of Reserve Bank of Australia Chief Philip Lowe, and Deputy Governor MICHELE Bullock was announced his successor. Currently, the key interest rate in Australia is 4.10%. This is much lower than in the United States, where the Fed has already raised it to as high as 5.50. With such a gap, the Aussie dollar pair is highly likely to move into the bearish territory. In the Asian session, the Australian dollar lost its bullish momentum and dropped below the weekly low of 0.6400. Weak China's economic data for August put additional pressure on the Aussie. Additionally, bets on another US rate hike are supporting the greenback, dragging the pair down within the range of 0.6370 and 0.6467 on Tuesday. As a result, the Aussie dollar pair may touch the earlier low of 0.6365 reached on August 17. The New Zealand dollar also lost hope for a bullish trend. Once the greenback returned after the long weekend, the Kiwi had nothing to offer against the US dollar. The Kiwi dollar pair slid below 0.5880 and the New Zealand dollar was under pressure within the range of 0.5874 and 0.5950 throughout Tuesday's Asian session. And that's all for now. Leave your comments down below and don't miss our next video review. Remember that staying up to date is the key to success in your trading, and see you online soon.